Good morning, everyone, and welcome. Thank you for registering for today's webinar, which is the first in a series that we are planning with HotStats. Each quarter, Michael will be updating us on recent hotel performance, and we're both delighted to be kicking this off today. My name is Jane Pendlebury. I'm the CEO of HOSPA, the Hospitality Professionals Association. It's Tuesday, 24th of June, 2025. It's 11 a.m. in London, and the UK is still enjoying some more weather, but not quite as much sunshine as we're used to. Michael and I are due to be chatting for around 45 minutes today, with time for questions at the end. And Michael will kick us off shortly with an introduction from him, and he will then share some slides and relevant data captured through to, I think, April this year. Please do ask questions throughout using the QA option at the bottom of your screen. If there's not enough time to answer the queries, then we'll get back to you afterwards, but please just pop them in there at any time. But I'm just going to hand over to Michael now. My job's almost done. It's over to you now, Michael.
Thank you, Jane, and hello, everybody. Good morning. We are just on the brink of publishing our May data today. So literally last minute, and I'm talking like 10 minutes ago, I managed to just get a little snippet of May that I'll try to include, but most of the slides are up until April at this point. So yes, I will just, hopefully you can see my screen already. So as an intro, for those of you who don't know us, hopefully you do by now, HotStats is a global benchmarking company. We collect P&L data from hotels all around the world. We've, of course, started from the UK, so have quite a large presence here, but also very much across the pond now in the US and most of Asia. And what we do with that data is we collect on a monthly basis, we map it into the uniform system of accounts, and we deliver benchmarking services to operators, owners, and then on the other side of our business, we also provide data to governments, banks, etc. You'll see from the slide deck that we were recently acquired last month by, in April now, by Duetto. So you'll see across my slides, HotStats is now a Duetto company. And yeah, exciting times for us. We're now up to around 12,500 hotels globally. And we are delivering around 500 KPIs for obviously overwhelming amount of data, but whilst trying to navigate what seems to be entering into a more difficult time for hotels around the world, and specifically in the UK for numerous reasons that I will touch on. I think I'll leave the rest of the sales pitch there, but if you have any more info, my contact details will be available as part of this and also at the end of the slide deck. So yeah, let's look at the April performance. I have the luxury of not just presenting in forums like this. I present for the individual operators as well at their various finance and operations forums generally, also some of the commercial ones. In addition to that, I also present quite a lot for the investment community. So I try to draw some of the context from not just what's happening on the ground from the operational side, obviously what I look at through the data, but also another view from outside in the longer term from kind of some of the investor sentiment. And I start there at the kind of macro picture. So this is looking at gross operating profit per available room on a 12-month rolling basis. The reason we look at it this way, which is maybe not so apt for an individual hotel looking at the current month in time, but if you really want to understand what's going to happen in the future and which direction the markets are heading in, I think it's quite interesting to take the macro view and understand the fundamentals behind some of the market performance. So you see from the graphic on screen, I've just taken the four huge market regions in the globe, around the globe, because there are some kind of nuances in these numbers. But as a general theme, the revenues have been slowing for certainly for the last 12 months. I think when I presented at HotSpace was probably the first time we really started looking at this in a bit more detail and saying, okay, we are definitely seeing a point in time where the revenues are growing slower than the costs. And therefore, on an ongoing basis, this is a challenge facing hoteliers. And you can really see that from these numbers. The Americas generally had seen pretty much a flat line. Believe it or not, most of the numbers in the positive part of the numbers in Americas is propped up by South America. The US performance has been really flatlining for some time now from a profitability perspective. Middle East continues to grow and outpace Europe, albeit Europe is still in a positive trajectory, so still heading upwards, but very much slower than where we were those kind of 18 months ago when we were ramping back up on the back end of the crisis. And as you can see, Asia Pacific seeing the tail off, so a few different stories in the macro numbers. Now, if I take that to the kind of vertical view and just look at the year in its totality, I'd like to get some credit for my title of the slide, by the way, the terrific start, because I think that has been very much the theme. We've, of course, been front and center of trying to monitor not just the impact on hotel top line performance and demand, but also the impact on the cost lines for hotels in and around the region. Now, you can see for the full year of 2024, you shouldn't be that surprised. I'm sure you would have seen us, or hopefully seen us present some of these numbers already last year. But US performance there, 3% growth or just under, turned into almost zero profit. It's a good reason why we focused both on the total revenue picture and then also the impact to the bottom line, because they often do not correlate directly. Europe, totally the opposite, coming off the back of a really difficult 2023. So pretty substantial profit growth in comparison to pretty strong revenue growth. Asia Pacific pretty flat overall, but again, most of that dragged down by the Chinese performance, and then Middle East going from strength to strength. Now, if you look at the year-to-date picture in 2025, the story really is that flow through both in Americas and Europe has been fairly strong overall. And you can see across there on the Middle East performance, very similar. So it certainly seems to be a year for flow through. If we see the revenues, if we see top line growth, that in general has converted into bottom line performance. However, if you look across the European markets, it really does show quite a different picture, depending on which market you're in. Certain nuances with regards to cost challenges, certainly in the areas of energy and labour, have impacted the likes of Portugal, Belgium, Austria. You can see that on the left-hand side, with little to zero revenue growth, converting into negative profit territory. Those that have seen substantial revenue growth there further on the right-hand side, or the middle to the right, you can see have mostly converted to decent levels of profit. So it's really been a revenue story, because we are living with quite substantial cost increases right across the continent. The UK there, that kind of fourth from bottom, I guess, if we were to look at it this way, with pretty flat revenue positioning. So it's around it's actually just under 1% year to date there, 6.6% down from a profitability perspective. And you can see how that compares to the other markets. So the UK in pretty tough territory, and I'll come to that in a moment. Yeah, okay, I won't go any further on that one. That was just to help any rugby fans who want to give me some hassle later on. From the year-to-date performance, you can see, overall, this is how it broke down. So that TrevPAR drop of just under 1% on the left-hand side, mixed with labour increases around 4.3%, drove a 6.6% drop in profit per available room overall. And now, of course, that was the year-to-date picture. It's propped up by a few months. We're all aware of April, where we saw the increase of national living wage, the impact of the national insurance changes as well, and a very small credit from the employer's allowance point of view. But generally, overall, you see the picture there. If we just compare the year-to-date pictures, around 4.3%. The impact of April there at 5.3%. So you could quite easily assume that the impact on the bottom line from those changes so far has been around 1 percentage point of payroll margin, and therefore 1 percentage point of profit at the bottom line. So from that point of view, the impact overall around 1 percentage point is no small number, right? But just for context, as I'll show you in a moment, the UK saw around 3 percentage points drop off of profit margin, impacted by the energy costs and the food and beverage cost challenges over the last few years. The 1 percentage point is a real hit in the side for UK hoteliers. Now, as I mentioned, I managed to get some May performance numbers just literally a moment ago. That's why, sorry, I haven't had a chance to make it look pretty. I just wanted to throw this in last minute. So these are provisional numbers. We'll launch the data by the end of today. But you can see there, the numbers are really not that different from May. So we've seen actually a larger impact of the labour cost increases, around 6% for the month of May. Around 6.4% down from a GoPar point of view, and then from a TrevPAR point of view, just slightly smaller than the impact of April, but still, in fairly negative territory. So I'm sorry not to be able to give much good news from that point of view. Certainly, you can see the year-to-date picture, the April numbers and the May numbers really stack up against each other in pretty consistent bleak picture. And what I've done here quickly to also just try to, display this a bit better, during that kind of ramp up period, post the crises, you can see, well, in fact, during the crisis, you can see revenues dropped more than the labor costs. So we still had to retain some labor, but we lost most of our revenues. If you look at the impact, I'm sorry, what this graphic is doing, it's not that straightforward to kind of just see that. It's every month compared to the previous month. So it's literally looking at a percentage change month on month on a 12-month rolling basis. So it's literally to try and understand how much this is moving on an ongoing basis by looking at it on a month-by-month index. So on the left-hand side there of the COVID, you can see that we had this issue of revenue dropping more than labor. We came out of COVID and we had the luxury of revenues growing much faster than the labor costs, and I think that has been, to our benefit as we saw this ramp up coming out of the pandemic. And I've just zoomed in on the kind of last couple of years here. You can see it really bounced around, but if you look here on the left-hand side, if we look at the on the right-hand side, the 12-month rolling average picture as of basically November, December time has been that labor costs have continued to grow and completely outpace the revenue direction, which again has been pretty unprecedented on an ongoing basis, as you could see from the graphic. So we are going into a much more difficult time where labour costs are definitely growing more than revenues in the UK. If you look at the impact that's had year to date on the various markets around the UK, so again, if you haven't seen this slide before, on the right-hand side, we're looking at revenue growth. The top half of the slide, we're looking at GOP margin growth. So overall, there's only a handful of markets that have actually seen margin growth year to date versus last year. Most are in the red, as you can see on the left-hand side there. So revenue declines and margin declines at the same time. And then the blues on the right have basically seen revenue growth, but nothing in the way of margin increases. So yeah, real, challenge, I think, for UK hoteliers to look at. I think the only pattern we could really see from the regression analysis was that, if your market is growing more than 3 to 3.5%, that's the point where you basically start seeing margin growth to offset these cost increases. And then if you look at the UK, just split it between provincial and London, you can see there that the real difference is that London has very much surpassed the 2019 levels from a TrevPAR perspective, also from a profit perspective. And then if you look at the provincial UK, which is on the bottom there in orange, even if you don't adjust for inflation, you can already see that not quite back at those 2019 levels. So the ongoing challenge has been that we really haven't managed to fully recover from a UK hotel perspective. And that is even, I think, again, I'll use our friends at STR stat, which is, the UK runs at the highest occupancy of the G20 countries. So it's not like a market that's really struggling overall, but it's certainly in context of, the revenue potential, the rate growth, and then the ancillary spends mixed with the challenges we've had with energy and labour costs on an ongoing basis. And if you look at the UK here, at the macro picture, what this is doing there is on the left-hand side, we're looking at the year to date. So we've got the GOP margin versus the prior year. So you can see the change there, the drop off year on year. I would also point out that at this time of year, if we look at the year to date picture, it's quite normal that we see lower profit margins than we see for the full year picture. And also, if you look at the food and beverage there, the average UK hotel now is running at less than 20% profit margin in food and beverage. Again, another key challenge and lots of creativity out there in the hotel space at dealing with that challenge and hopefully convert into an opportunity. On the right-hand side, what we're looking at there is versus 2019. So that's that 3 percentage points drop you can see between 19 and 23 from a margin perspective. You see the growth there in 24. So we saw pretty, I think overall hoteliers would have been fairly happy with 2024. But you can see on the 12-month rolling basis, it's already heading south as we go into 2025. So we're looking more towards the 2023 number from a margin perspective for this year. For provincial UK, the story's not that much different, other than the fact that really we didn't see that huge uplift in 24 versus 23 in the same way that you saw on the macro picture. And overall, the profit margin has dropped around 4 percentage points since 2019 for provincial UK. So certainly been hit harder than London, where you can see here, for instance, London performance dropped by around 3.5 percentage points over that period, but we've already managed to get to 42% there, so just under 3% down on the 2019 numbers overall. And in fact, I'll also highlight food and beverage there. So if you look now, not just under 20%, but London hotels now hovering around the 15% mark from a profit margin point of view. Now, I'm going to try and throw in a few positives because, of course, we will look through the numbers and you can always find them, which is the great thing about looking at data like this is that, it's not, there's always going to be the areas that you need to focus on, the areas that may be areas of opportunity or challenge throughout your strategy. But what this is really showing is that those top segments there, you can see the Smurth conventions, some of the contractor business, etc., have seen pretty substantial segmentation ADR growth by segment there over the last 12 months. The challenge for us is, of course, that the retail, wholesale, negotiated, and corporate segments make up such a large part of the pie for UK hotels. And of course, when you've seen such little growth in those segments overall, that does, of course, cause the challenge from a overall ADR point of view. But there are definitely opportunities within the segmentation, and of course, the challenge for hoteliers is to make sure we maximize the most profitable segments, take advantage of the the demand patterns that we can see here. And if you look at the other revenues, well, overall, we look at the 12-month period now, we've certainly seen that slow down. So I was reporting pretty positive growth in C&B revenues coming up to HOSPA last year, but we've really seen the slowdown over the last 6 months. Now, again, our friends at Venue Performance, who co-presented with us there, are talking about pretty positive forward-looking business on the books for C&B for the rest of the year. So there is maybe some positivity in the numbers. We of course only have access to the historical numbers here. Food and beverage performance, you can see there that 1.8% growth is really minimal considering the size of the cost increases. But those ancillary revenues of golf, wellness park, and those hotels that are lucky enough to have other levers, other services to drive, are taking advantage of those. And I think this has been the consistent message across all of the conferences I've been to this year, is that we know food and beverage is a challenge. We know that demand overall is slowing, and we have this challenge from a top line perspective. It's not just those three levers of if you are lucky enough to have golf, wellness, or large car parks that you're going to be able to drive ancillary revenues. There are lots of other options and creativity that hoteliers can get back to the table and really look at what we do, what we sell from a hotel perspective, above and beyond just selling bedrooms. And this has really been the key picture. So from a conferencing point of view, it is a bit of a mixed bag. So you can see here on the kind of left-hand side, the markets in order of drop off year on year. So it was actually interesting, as I presented with Venue Directory a few weeks ago, that our numbers look really similar, which is quite refreshing. You could see here, this is on a per square meter basis. So Swindon, Sheffield, Brighton seem the largest tail off year on year, and the biggest opportunities seem to be in Leicester, Bournemouth, Birmingham, as you can see there on the bottom. Now, from a labour point of view, well, overall, as you would have seen from my previous graphic, we are looking at pretty substantial labour increases year to date. Across the board, you can see that it does impact most of the departments at just that kind of 6 to 8% mark. Food and beverage much lighter than the other areas, which I thought was quite surprising. But I think that's probably the area the hoteliers have hit the hardest, knowing that revenue performance has been slow. And of course, at a time where we're seeing revenue slowing, demand challenges, I would also question the wisdom of the lower A&S costs year on year. This is looking at April versus April. So you can see there the kind of lowest increase we've seen year on year from a departmental point of view has been actually in the area that probably drives a big chunk of the revenue. So I think, again, another interesting piece to look at from a hotelier perspective. If you look at the actual expenses, well, this has probably been our tailwind for a little while as we've seen costs starting to, come down. Labor has definitely been the real challenge, and energy costs for some time. Energy costs continue to head south. We are entering the period of the year with the lowest levels of consumption, albeit you don't know what of course the obvious conflicts in the world are going to cause from a cost perspective there. Supply costs have continued to fall, and again, coming from a pretty high base, of course, as inflation has slowed, we have seen the impact of that on the cost lines. And maybe due to the segmentation, so a much higher kind of group and Smurf business on the top has driven less in the way of booking costs. But overall, we are still dealing with, pretty high levels of labor cost growth, and we're not really able to offset that just by a drop in prices from a supplies point of view. And for that reason, my message has been really around driving revenues and getting back to the table and looking at the best ways that hotels can really look at opportunities to pull new levers and drive new revenue streams. Um, Labour will continue to be our challenge, and the overall impact on labour costs for certainly in the lower ended wage levels of the hotels. We're expecting to see that 7 to 10% increase overall. Um, and then as you look at, that's going to be on wages, not just on the cost total labour cost, because hotels will have to find a creative way to offset some of that. Slowing C&B growth, as I said, it's not consistent across the board, but generally we are starting to see, or we have seen that in the year-to-date numbers. The costs are showing in general, or slowing in general, sorry, but margins are under pressure, and overall, energy costs have been the real prop up for us as they continue to fall, and of course have a positive impact on the margin overall. So I think I was bang on 20 minutes there, Jane, which is pretty impressive for me.
That's perfect. Thank you. And some really interesting bits there. And we do have some questions. So do keep them coming in. One of them is it's about France. What explains the rather positive GoPar increase year on year for France despite a more modest TrevPAR growth?
Yeah, again, there's the real mixed bag of kind of nuances in the cost lines, right? So less impacted from a labor cost perspective. We've seen the energy costs come down, pretty heavy across Northern Europe in general. I think France has had the benefit of that. Majority of it has been actually, although you can't see in the numbers, it's not been necessarily a demand story. France has seen a real growth in ADR, and I think that's been the positive from a profitability point of view. But yeah, you're right. It's on the back of an amazing year. 2024 was also a great year for France. So France is really, headed in the right direction from a profitability point of view.
Brilliant. There's another one here about London specifically, and a question. This could be, it's an interesting one. Why is London so much better than the rest of the UK, especially when you show golf and wellness as being the larger contributors to increased revenues? Is it just that it's the capital? And this might be more of an STR type question. Is it mainly corporate business, meetings and events, or tourism?
That's an interesting one. I mean, we can pull the numbers from the segmentation. So we could actually look at the analysis of what is going into London to kind of drive these numbers. But from a fundamental point of view, London just continues to outshine the rest of the UK from a performance point of view because of the fundamentals it has. It has a really nice mix of an amazing leisure destination where we're really able to kind of drive incredible rates from a leisure point of view, and then almost the same hotels in the market are able to drive incredible business groups and corporate into the city. So it's really unlike pretty much any other city in the UK and for much of Europe from that point of view. The levels of occupancy that London hotels generally run at is incredible. Even as we add a significant amount of supply into the market, it's still I believe from a supply point of view, it's still the hottest market in the world from from a supply perspective. So yeah, it just continues the fundamentals of London are just different to everywhere else.
And does that work across from Paris to France and the other capital cities across Europe, or is London still, obviously with the supply, it's exceptional, but is it exceptional with that compared Paris to the rest of France, for example?
Yeah, I mean, Paris also has, I mean, I believe Paris is the most visited city in the world now. It was certainly from a international arrivals point of view, France completely outpaces the UK. But France has other, not only major hubs, but Paris has different fundamentals, right? The UK has an incredible domestic market, and London also feeds from that domestic market. We also have, of course, the relations and the income in travel that we have enjoyed over the last kind of few years from the Americans come in as the dollar's been stronger and the pound's been weaker. We've also been able to ride on the back of that, probably in a way that, a bit above and beyond. But it's been hard to compare because Paris had the run up to the Olympics. It's also had the Olympics and then the post-Olympics impact. So, there's a few different things to talk about within those numbers.
Yeah, cool. There's one here. It's a long question. What are the countries that you expect to see more marked costs growth over the next 6 to 12 months, whether labour, regulation-led, or anything else? Any more visibility on property tax elevation next year for the UK? And then there's a third part. Finally, nearly a year ago, you highlighted this staggering increase in insurance expense. What are the most recent trends on this item? So
Yes,
there's three
the
parts.
insurance bit was incredible, right? The insurance issues that we had last year it was very much a Northern European and American issue. So we saw insurance costs increase by 60 to 70% over that 3-year period, and that really has quite a substantial impact, not just on the hotels themselves, but of course everybody that they work with. All of the suppliers are also absorbing those costs. People at home are also absorbing those costs. So there are like incredible impacts of those things. The property rates bit, to be honest with you, I don't know very much about. I'd have to look further into that because I don't really know what the impact of those will be or the likelihood of it. Um, and then the other question on which countries we think will see the largest growth.
Cost growth over the next 6 to 12 months, whether labour, regulation led, or anything else?
Well, I think there is the challenges around supply, without being too political on this matter, the UK certainly struggles more than the other European countries, or certainly the EU countries, from a labour point of view, because of the challenges we have around importing labour. So that naturally drives up the cost of that, as it has done over the last few years, the cost of the supply of labour increases, and of course causes lots of other challenges. So I'd say the UK, from a labour cost point of view, has been more impacted. Um, from a from an overall cost point of view, the UK was and is living with higher energy costs than most of Europe. And on the back of that, as coming from a higher base, obviously has more opportunity to see costs fall. As this continues to normalize. I had an email this morning from my energy provider again, finally saying that the energy costs have come down further, so I'm paying less. I'm hoping that that impact overall will continue to be a positive tailwind for the UK. So I think from an expense point of view, the UK may be in a better position than some of the other parts of Europe. There is also, of course, the switch away from as countries are trying to switch away from the use of Russian oil, etc. And they're likely to see, like the likes of Germany, etc., who've now been contracting and changing the way that they procure and utilize energy. Will cost more overall, as the I guess economists are expecting. And on the flip side, the UK continues to to see energy costs falling. So I think the overall impact on supplies and everything that comes with that is in the positive for us. The other
Okay.
thing will be the impact of tariffs, by the way, which again is a political nightmare, and it's so uncertain at the moment. I don't think it's worth really having a full-on discussion on it. But of course, EU countries, in general, will have a different impact to what the UK has seen overall. So again, that will have a pretty uncertain impact on the cost lines right now.
Yes, and uncertainty is never good, is it?
No.
On the subject of tariffs, we've got a question about the US traveller segment, which is actually something I hear a lot when I'm out and about. And the question is, any views on the US traveller segment and the slowdown in volume and or ADR, so specifically US?
So the ADR impact is difficult to judge. The one thing that so I've actually been to the US 3 times this month for different presentations, and we continue to kind of focus on um, the real, like, keeping an eye out for what the impact will be on US performance. And you would have seen from my previous slide, I didn't actually manage to show the US because this is a UK presentation, but I had the total Americas picture there. Now, the US start has actually been much better than last year, right? So the start of this year has been significantly better than last year from a demand point of view. We are looking at numbers up until April, so now we'll get the chance to look at the kind of May performance and see if there has been any tail off. But the economists and the industry reporters in the travel segment have been talking around this global, so the slowdown of international arrivals was something around 12%, I think, for year to date. And then the Canadian travel into the US has dropped by something like 17%. These are numbers, by the way, I'm throwing them out there. They're from memory. That's what they told me. But as you see any of those kind of numbers, even if they are, as soon as they're in the double digits, you are expecting to see the impact on US performance. The difference has been, from what I understand, is that the Americans are also not traveling as much as they were last year, for similar reasons. So the domestic business has been stronger, the international business has been weaker, but overall, the US performance has been pretty well propped up year to date. And there's obviously been quite a lot of government activity, I guess, driving hotel business as well.
Cool. There's one here about OTAs. In London, we're seeing a big increase in commission percentages in 2025, partly driven by a change between Booking.com that is on a gross rate, driving up ADR and commission relative to Expedia that comes in with a net rate of commission. Is that a trend being seen across other hotels? Now, I wonder if you know, or whether we're going to have to ask our other delegates to put their
Yeah, I
word
think it'd be
on that.
interesting to hear that if that actually is a thing. I mean, we report on net RevPAR and net ADR to take that out of the equation. I'm assuming when they talk about gross versus net, we're talking about deducting at source versus rebilling. If we're talking about I think Booking.com changed a fair few years ago now that they charge the commission on the gross rate. So that's been around for some time. I don't think has changed much. But yeah, I mean, overall, I wouldn't be able to answer the impact of it. What I will say is that the numbers say that the volume of OTA commission has dropped year on year. But I think that again will be a segmentation shift more than an actual hoteliers paying less to OTAs overall.
Yes, and he has confirmed that was commission and not VAT.
Yeah.
Um, do keep your questions coming in. We do have one more currently. Well, this could be interesting. You mentioned parking as being a great revenue source. Is that city centres typically? And the second part of that question as well is, so first of all, is it city centres or elsewhere as well? And does that include EV, electric vehicle charging revenues?
Yeah, so it does include the EV charging revenues, and we've been so I've been flying the flag for a while that, as we start to see this slowdown, we've been going through the luxury of pretty, strong ADR growth and profit growth for, pre-COVID, and then coming out the other side of the pandemic. Of course, we saw this incredible ramp up. So you'll hear me I'm constantly repeating this as I hear in the forums, this need for us to really look at at making sure we charge for as much as possible without destroying the guest stay. So, there are many hotels still in the UK that don't charge for parking, even in the city centres. And then you have others that charge, ridiculous amount to the point that people don't park in hotels, right? So I think that whole balance is a difficult one. We actually did, I think I mentioned this at Hospice, we did this study around 2 or 3 years ago with a developer who was looking at hotels at Heathrow and the profitability on the parking spaces versus the hotel bedrooms, which I thought was like, it's a fascinating exercise because we as hoteliers are so zoned into hotel bedrooms, RevPAR, occupancy rate, and then, screwing the cost lines. We're really not that great at kind of joining up not only just benchmarking and measuring the rest of the P&L, the rest of the revenue streams, but also analyzing them and trying to think about, right, are we really set up for maximizing that space, and can we make money from not only having our own parking but also maybe leveraging other space around us and coming to those agreements. So parking, the net result is that basically those parking spaces make around about as much money as the bedrooms from bottom line point of view. There were circumstances where I think the analysis showed that the parking made more, because at the bottom line they don't have any costs attached, right? It's you charge much lower than a hotel bedroom, but they run at nearly 100% profit. So yeah, the majority of the parking revenue, I believe, will come from the airport hotels, but we need to, just because of the sheer volume and the size of them. But yeah, we would have to analyze that. I can't answer that directly.
Yeah, no, okay, interesting. And there's lots of comments here, and I would say use the term comments, it's more rants about the increased labor costs and how cross people are about it. There's two or three different people that have mentioned that, but no specific questions because I think we all do know where we stand on that. But yeah, I have no more open questions at the moment. So really it just leaves me to thank you, Michael, for updating us so clearly and yet so much detail as well, which is good. Michael and I do both attend many industry events, and I know he mentioned this earlier, but it's interesting to spend time with fellow hospitality professionals, and we get much more of a feeling of how the impression of how they're feeling, and it's great to see the data will back up some of those gut reactions. So it's definitely worth getting out and about and visiting people if you can. I always think the value of networking is sometimes underestimated, just to speak to other people and find out what they're doing. But thank you, everyone, for listening. Your feedback is very welcome, and we will be doing 4 of these webinars a year, as I mentioned at the beginning. So we would appreciate your thoughts. And if you would like us to invite an operator to join us on future broadcasts, then please just say so, and do volunteer yourself if you'd like to feel included. So please do that, or any suggestions welcome. Um, as always, if you need formal advice or specific data to your property, then please approach your professional advisors or come to me at HOSPA for a referral. And if you'd like an introduction to Michael and HotStats, then please let me know if you don't already know him, and I'll be really happy to connect you. And do take a look at our website. We've got other upcoming events, and recordings of this and all our webinars will be on our website and also on our YouTube channel. This one should be uploaded within the next few days. But thank you all for listening. Thank you, Michael, very much. That was really useful. And I look forward to doing these more regularly with you.
Yeah. Good.
Brilliant.
Have a good day, everyone. Take care. Thanks.
Thanks all. Bye bye.